Welcome back to our video series on the US tax reform. Today we would like to have a focus on the sale of partnership interests. Elisa, we talked in previous videos about the taxation of pass-through entities. But what happens now if I decide I want to sell my interest in a partnership?
Well, the short answer is it's taxable in the U.S. Not an answer I guess people want to hear, but
Probably not.
Yeah, how we get there though is a little interesting maybe for some, and basically we end up right where we started. So under our internal law and the treaty, it's always been clear that with respect to the sale of real property located in the U.S., so the sale of that property, whether it was held directly or indirectly through a partnership, was always subject to tax in the U.S. and exempt with progression in Germany. In addition, we always had U.S. withholding that was applied under our Foreign Investment in the Real Property Tax Act, what we like to refer to as FIRPTA, another nice acronym for us.
Beautiful.
And that's true with respect to real property interests, and that has not changed. But regarding the sale of a U.S. partnership interest that's not a real property interest, that is actually taken, gone full circle, really. So the IRS has always taken the position that this should be taxable in the U.S. And then we had a case not that long ago that actually held that it was not going to be taxable in the U.S. And now under the new law, they've come all the way back around to the IRS's position and has said this is definitely going to be taxable in the U.S. So we thought for a while we were going to, have some benefit and be able to maybe take the position under this court case that it wasn't going to be taxable here if that was beneficial. But now that they've actually written it into the law, we're not going to be able, to do that. But we've been told by our German colleagues that we think that it should still receive exemption with progression treatment, in Germany.
Okay, good. Lisa, I think you said earlier that the sale of shares in a corporation are not taxed in the US. Is that actually true?
Yes, that's actually true, and that has always been the case under both our internal law and under the treaty. The sale of shares is considered the sale of an intangible asset, and it's taxed based on the residence of the seller.
And is there anything else or any other requirements out there if I'm selling my partnership interests in the US?
Yes, actually, so it's really more on the buyer, but we now have a new rule in place that when someone is selling a partnership interest, the buyer is actually required to withhold 10% of the proceeds of the sale unless the seller can certify that they're a U.S. citizen or a U.S. resident, which most of our, obviously, German sellers are not going to be able to certify that they're a U.S. resident or a U.S. citizen. So they can look forward to 10% withholding on their sale.
Okay. But I think that is important to know and that you fulfill your obligations.
Absolutely.
Elisa, I think this was very helpful. Thank you very much. And yes, please look at our webpage. You will find other videos on the US tax reform where we go into detail on other important topics. Thank you.